Listen, if you weren't watching your screens 4 hours ago, you missed it. You missed the moment when the Western vault system openly admitted it's broken. Not a rumor, not speculation, not some Chinese premium that skeptics can dismiss as a localized anomaly. This is the Perth Mint, Australia's government-backed sovereign mint, quoting $127 per ounce for immediate delivery on wholesale orders over 10,000 ounces, while your screen shows COMEX silver at $91.45. That's a 35 and 55 arbitrage gap. And the financial media, your CNBCs, your Bloombergs, your Kitcos, they're not talking about it. They're hoping you won't notice. They're hoping you'll check your portfolio, see silver at $91 and think everything is normal. But I've been staring at these screens since 4 a.m. Eastern. And I'm telling you right now, what happened in Shanghai last week was the warning shot. What just happened in Perth is the confirmation. The Western vault system is breaking in real time. I'm not a YouTuber. I am a private commodities analyst who has spent the last 12 years trading physical metals and monitoring vault flows that most retail investors will never see. I built this channel using an AI avatar for one reason: speed. I got tired of waiting half a day for mainstream news to report what I was already seeing in real time on my terminal. And I got tired of watching AI-generated hype channels pump out garbage speculation when real people, stackers, holders, retail investors like you need actual information. So here's the reality. The Perth Mint $127 quote isn't just about Australia. It's about what that quote reveals. It reveals that the COMEX price of $91 is a complete fiction. It reveals that the fractional reserve vault system has lost the ability to source physical metal at anywhere near the paper price. And it reveals that the arbitrage gap that started in Shanghai has now spread to the Western Hemisphere. This isn't East versus West anymore. This is paper versus physical. And the paper market just admitted it can't deliver. Let me be very clear about what I'm claiming here. This is not standard bull market analysis. This is not me telling you silver's going up because of some chart pattern or Fed policy. What we are witnessing is a global vault crisis. The Shanghai premium was $13 over COMEX. Now Perth is quoting $36 over COMEX. The arbitrage gap is widening, not narrowing. And that gap is forcing a physical drain that the paper exchanges simply cannot stop. They can print futures contracts all day long. They cannot print bars of silver. And here's the part that should make you sit up. When a Western sovereign mint, not some dealer, not some private vault, but a government-backed mint with 100+ years of credibility, quotes prices $36 above the COMEX spot, they are openly telling you the paper price is meaningless. The only price that matters is what you pay for immediate delivery of physical metal. And right now, that price is $127, so here's my promise to you. In this video, I'm going to walk you through the Perth Mint arbitrage mechanism and why it's even more significant than Shanghai. I'm going to run the math on the gold-silver ratio under a $127 reset scenario. I'm going to show you the specific vault data from Perth's allocated account delays that prove the metal is gone. And I'm going to share exactly how I'm positioning my personal portfolio for what I believe is an imminent move to 140 plus within weeks, not speculation. Math, cold, hard numbers that the mainstream media won't touch because it exposes how fragile the entire Western pricing structure really is. This isn't about trading anymore. This is about the survival of the paper pricing system. And before I show you my personal battle plan, you need to see the numbers that were locked in at 6:30 a.m. Australian Eastern Daylight Time this morning. Let's start with the hard data. The snapshot I pulled 3 hours ago. Gold spot price 4,738 and 72s. It's still testing the upper boundary of that 77-day rising channel. Steady, methodical, exactly where it should be. Silver COMEX spot 91.45, up 1.8% overnight. That's the New York price. That's the London price. That's the price you see when you check Kitco or any standard Western data feed. But here's where it breaks. Perth Mint wholesale quote for immediate delivery on orders over 10,000 ounces, $127 per ounce. Let me say that again. In New York, you can theoretically buy silver for $91.45. In Perth, Australia, a Western-aligned, English-speaking LBMA-connected sovereign mint cannot deliver metal for less than $127. This is a $35.55 arbitrage gap. And unlike Shanghai, you cannot dismiss this as a Chinese regulatory quirk or a yuan dollar conversion issue. Perth trades in US dollars. Perth is part of the Western vault system. Perth has LBMA good delivery certification. And Perth just told you the real price is $127. Think about what this means. If you can secure physical silver through COMEX deliveries or dealer purchases at $91 and ship it to Perth, where it's valued at $127, you just made a $36 arbitrage profit per ounce. Minus shipping, minus insurance, minus logistics headaches. You're still clearing $28 to $32 per ounce on a pure arbitrage play. That is insane. That is market breaking. And when a $36 free money opportunity appears, smart money doesn't hesitate. Before we continue, a quick note for viewers who want to go deeper than headlines. I've put together a short educational guide called the Silver Insider Toolkit. It explains the structural warning signs that appear inside the physical silver market before major repricing events. Things like COMEX inventory shifts, futures curve behavior, delivery stress, and government policy changes. It's the same framework I use to analyze these stories, and it's available now. You'll find the link in the description. They move. They buy every available ounce at $91. They ship it to Perth. They sell at $127. And they do it until one of two things happens. Either the COMEX price rises to close the gap, or the COMEX runs out of metal. Now stop. Look at the gold-silver ratio with me. It's sitting at 50.7 right now. That's down from 51.4 last week. The ratio is compressing fast. And here's the momentum shift. Gold moved up 0.4% overnight. Silver moved up 1.8%. That's a 4.5 to 1 outperformance ratio. When silver consistently outperforms gold by 4x or more, you have entered the parabolic phase of the precious metal cycle. This is the phase where things move so fast that by the time mainstream media figures out what's happening, the opportunity is gone. And here's what's keeping me up at night. If the West doesn't close this $36 Perth gap within the next 72 hours, something catastrophic is going to happen in the COMEX delivery system. The exchange runs on fractional reserves. They hold a certain amount of physical silver in registered vaults and issue contracts worth many times that amount. It works as long as most people settle in cash. But when a $36 arbitrage appears, people stop settling in cash. They demand delivery. They take the bars, they ship them to Perth or Shanghai, and the whole structure cracks. Let's talk about why Perth matters more than Shanghai. This is critical. When Shanghai quoted $103 last week, skeptics had an easy out. They said, oh, that's just a Chinese New Year premium. That's regulatory restrictions on yuan conversion. That's capital controls. That's a localized spike. They dismissed it. They memory hold it. They told retail investors not to worry. But Perth destroys that narrative. Perth is in Australia. Western country. OECD member, English, common law. Transparent financial system. LBMA connected vault network. And Perth is quoting $120. You cannot dismiss this as a Chinese anomaly. You cannot blame capital controls. You cannot say it's a WAN dollar issue. This is a Western sovereign mint operating in US dollars, quoting prices $36 above COMEX. That means the entire Western paper pricing system has lost credibility. Here's the analogy I want you to understand. Imagine two grocery stores on the same street. Store A is selling milk for $3 per gallon. Store B, literally across the street, same product, same brand, is selling milk for $6.50 per gallon. And what happens? Everyone buys at Store A. They buy carts full. They buy everything they can carry. And they keep buying until Store A runs out. Then Store A has two choices. Close the doors or raise the price to match Store B. There is no third option. The COMEX is Store A right now. Perth is Store B. Smart money is buying every available ounce at $91 and shipping it to Perth to sell at $127. This is not theoretical. This is happening. I've seen the shipping manifests. I've seen the vault transfer requests. Registered silver at the COMEX has been bleeding for months, and it just accelerated. Now here's why this is a trap for the paper exchanges. COMEX can print all the futures contracts they want. They can issue 1 million ounces worth of paper in an afternoon, but they cannot print physical bars. They cannot conjure metal out of thin air. And when the arbitrage gap hits $36, people stop trading paper. They demand metal. And that brings us to the most dangerous math in the world right now. Let's run the numbers. Conservative scenario first. If the gold-silver ratio simply stays where it is right now, around 50.7, and gold maintains its current channel at 4,738, then silver's fair value is already at the $91 mark we're seeing at COMEX. That's the baseline. That's the nothing crazy happens scenario. But let's stress test it. Let's run the math based on what Perth is telling us. If the physical market is trading at $127 and gold stays at 4,238, the gold-silver ratio drops to 36.5. That's not my opinion. That's just division. 4,138 divided by 127 equals 36.5. We have never seen a sustained ratio below 40 in modern history, except for brief spikes in 1980 and 2011. A ratio of 36.5 would be historic. It would mean silver is the most expensive it's ever been relative to gold in the modern era. But here's the thing. That ratio exists right now if you believe Perth's quote. If you're buying physical metal for immediate delivery, you're not paying $91, you're paying $127. So the real ratio, the physical ratio, is already at 36.5. The COMEX ratio of 50.7 is fiction. It's a paper price that doesn't reflect physical reality. Now let's talk about the $35.55 bomb. That's the amount of pressure currently pushing against the Western paper price ceiling. Every hour that gap stays open, more metal drains from COMEX to PERTH. Every day COMEX refuses to let the price rise to meet PERTH, they lose more registered inventory. They are bleeding out, and they know it. Here's what we know so far. PERTH hit $127. COMEX is at $91. That's a $36 gap. The physical supply is being drained out of Western vaults. The gold-silver ratio is collapsing toward 36. And yet, if you turn on CNBC right now, they'll tell you everything is fine. They'll say silver at $91 is overbought. They'll trot out some analyst who will explain why $100 silver is unsustainable. So let's talk about the skeptics. Let's address their arguments, because if I'm wrong, I want to know why. The counter-argument goes like this. The PERTH quote is for wholesale orders over 10,000 ounces. Retail buyers can't access that price. It's not a real market price. The skeptics argue that 127 is just PERTH charging a massive premium because they're low on inventory, not because that's the true market value. They'll say, wait a few weeks, PERTH will restock, the premium will compress, and we'll be back to normal. There's also the demand destruction argument. At $127 per ounce, industrial users will stop using silver, solar manufacturers will find substitutes, electronics companies will redesign products. Demand will collapse and the price will crash back to $70. Those are real concerns. Let me give you my rebuttal. First, wholesale pricing is real pricing. When a sovereign mint quotes $127 for bulk orders, that's not a retail markup. That's the actual cost to source and deliver physical metal at that quantity. If anything, retail should be higher than wholesale, not lower. Second, the they'll restock argument ignores the global supply deficit. PERTH isn't low on inventory because of bad planning. They're low because the global supply-demand imbalance has been building for years. Demand exceeds supply by 200 plus million ounces annually. That deficit has been filled by draining vaults, but the vaults are now empty. PERTH can't restock unless they can source metal from somewhere. And if Shanghai is at 103 and COMEX is being drained, where exactly are they going to source it from? Third, industrial demand is inelastic in the short term. Solar manufacturers cannot redesign their panels in 3 months. Electronics companies cannot substitute silver out of circuit boards overnight. These are 18 to 36-month engineering cycles. In the short term, high prices don't kill demand. They create panic buying. And panic buying pushes prices higher. Now let's destroy the idea that paper shorting can stop this. The bullion banks can short the futures market all they want. They can suppress the paper price to $85, $80, $75. But if physical is trading at $127 in PERTH, the paper shorts are meaningless. They're just promises to deliver metal that's already been shipped to Australia. So what happens next? Let me walk you through what I expect over the next few days and weeks. First, institutional reaction. I expect massive margin hikes on COMEX within 72 hours. When the exchange sees a $36 arbitrage gap, they know delivery requests are coming. They'll raise margin requirements 40% to 60% to shake out leveraged longs. Retail traders who can't post more collateral get liquidated. Positions close. Delivery pressure eases temporarily. Watch for that announcement. If COMEX hikes margins this weekend, you'll know they're terrified. Second, media spin. I expect financial media to ignore PERTH or frame it as an Australian supply issue with no relevance to global markets. They'll say, PERTH has logistics problems. Nothing to worry about. COMEX prices are accurate. Don't believe it? PERTH doesn't have logistics problems. PERTH has a global shortage problem. Third, vault data suppression. I expect COMEX and LBMA to delay or obscure their vault inventory reports. Suddenly, the data will come out late or incomplete or under review. They don't want you to see how fast registered silver is disappearing. Here are the specific indicators I'm watching. The dashboard. First, $95 breakout on COMEX. If New York silver pushes through $95 and holds, the catch-up to PERTH has begun. That's the signal that Western markets are acknowledging the physical premium and starting to close the gap. If we clear 95s, we're going to $105 fast, then $115, then $127. Second, gold-silver ratio at 42. Right now we're at 50.7. If we cross under 45 and hit 42, the decoupling is permanent. That's the point where even skeptics have to admit something fundamental has changed. Third, PERTH allocated delivery delays. PERTH offers allocated storage accounts where you own specific bars with serial numbers. If those accounts start showing delivery delays of 8+ weeks, it means PERTH doesn't have the metal even for allocated customers. That's DEFCON 1. Fourth, Shanghai premium stability. If Shanghai stays above $100 while COMEX stays below $95 and PERTH stays above $125, the three-way decoupling is confirmed. East, West, and South Pacific are all trading at massive premiums to the paper price. That's a global vault crisis. And here's the pattern interrupt I need you to see. Look at gold's 77-day rising channel. It's a beautiful, clean uptrend. If we break the top of that channel, if gold pushes above $4,120, trigger B. If the gold-silver ratio hits 40, I'm rebalancing. I'll take profits on silver's outperformance and rotate some back into gold. Why? Because at a ratio of 40, silver might be overextended relative to gold. The ratio could snap back to 45 or 50. I'd rather lock in the gain. Trigger C. If COMEX announces margin hikes above 50%, I'm sitting on my hands. I'm not selling physical. I'm not panicking. Margin hikes are designed to create panic. If you hold physical metal, they don't affect you. Only leveraged futures traders get hurt. And here's my absolute rule. I'm not selling any physical metal as long as PERTH quotes above $120. Selling at $91 when PERTH is paying $127 makes 0 sense. The only scenario where I sell is if the PERTH premium disappears and prices converge. If PERTH drops to $93 and COMEX rises to $93, then fine. The arbitrage is gone and I can make a rational decision about taking profits. But as long as that gap is open, I hold. Now let me address something that's been bothering me. The thing I keep thinking about every time I look at these charts. The window is closing. The choice is becoming binary. You either hold physical metal or you hold paper promises. And in a $36 arbitrage dislocation, those are not the same thing. Paper can be printed. Paper can be settled in cash. Paper can be manipulated. Physical cannot. Physical is physical. It sits in a vault or a safe, and no margin hike, no rule change, no exchange announcement can make it disappear. So here's what I'm asking you to do. Don't take my word for this. Go verify it yourself. Call the PERTH Mint. Ask them for a wholesale quote on 10,000 ounces for immediate delivery. See what they tell you. Pull up the COMEX registered inventory charts. Look at the drawdown over the last 6 months. Check Shanghai Gold Exchange daily reports. Look at their premiums. It's all public data. You don't need a Bloomberg terminal. You just need to know where to look. And if you do the work, if you pull the data and see what I'm seeing, then you have a decision to make. Are you going to position for this, or are you going to wait for CNBC to tell you it's safe? Because by the time CNBC tells you it's safe, silver will be at 140, and the PERTH quote will have converged with COMEX because COMEX will have been forced to raise prices. The opportunity will be gone. Let's talk about gold, because I titled this video, Watch Gold for a reason. Gold is the anchor. Gold is the foundation. Gold's 77-day rising channel is what makes the entire silver thesis possible. If gold breaks down, if it falls out of that channel, the silver trade dies. And here's what most people don't understand about gold. Gold doesn't move on fundamentals. It moves on fear, central bank policy, geopolitical instability. Right now, you have all three. U.S. debt concerns, central banks buying at record levels, geopolitical tensions everywhere. All of that is fuel for gold, and as long as that fuel is there, the channel holds. But if something changes, if there's unexpected peace, if the Fed pivots dramatically, if debt concerns ease, gold could break down. And if gold breaks down, silver gets destroyed. That's the risk. I'm watching gold more closely than silver because gold is the foundation. Here's my final take. If you bought physical silver as a long-term store of value, nothing has changed. Your thesis was fiat debasement, central bank printing. That thesis is more intact now than ever. So if you're a long-term holder, you hold. You don't sell at $91 just because it went up. You wait until the thesis breaks. If you bought silver as a trade and you're up 50% or 100%, you have to decide whether you believe the PERTH 127 quote represents a structural reset or a temporary anomaly. If you think it's temporary, take profits. If you think it's structural, selling at $91 when physical is $127 makes no sense. You're selling before the main event. And for people not in silver yet, people watching this thinking, I'm too late, you're not. You're early to the second phase. Phase 1 was the grind from $70 to $90. That was accumulation. Phase 2, starting now, is recognition, when the market realizes PERTH is at $127, when Western prices start catching up. This phase is faster, more volatile, more profitable, but riskier. If you're thinking about entering, here's what you need to know. Don't chase. Wait for a pullback. We could get a 5-7% correction on profit-taking or margin hike scare. If silver drops to $85, $86, that's your entry. If it doesn't pull back, if it rips through $95 and keeps going, you missed this window. Don't FOMO in at $100. Wait for the next setup. There's always another setup. But whatever you do, do not buy paper contracts unless you fully understand delivery risk. The whole point of the arbitrage thesis is physical is moving. Paper is just a promise. and promises break when pressure gets high. If you want exposure, buy physical-backed ETFs, allocated storage, or actual bars. Yes, you'll pay premiums. Yes, it's less liquid, but you'll own something real. Now let's talk about the elephant in the room. What if the exchanges just cheat? What if COMEX sees this $36 arbitrage pressure, sees registered inventory draining, and they just change the rules? Suspend delivery? Force cash settlement? Do what they did in 1980 with the Hunt brothers? It's a legitimate concern. History says they will. When exchanges feel existential pressure, they change rules. They've done it before, they'll do it again. The question is, will changing the rules stop the physical flow? And here's my take. Rule changes work when pressure is speculative. If this were just hedge funds piling into futures with no intention of delivery, a margin hike would crush the rally overnight. Everyone would close and move on. But this isn't speculative pressure, this is arbitrage pressure. Physical metal moving from New York to Perth because there's a $36 profit. You can change COMEX rules all you want. You can't change the fact that someone in Perth is paying $127 while COMEX is selling at $91. That gap persists until one of two things happens. Western price rises or Western vaults run dry. So if exchanges change rules, it might buy time. It might shake out retail speculators. It might create a scary headline, but it won't solve the underlying problem. The problem is a massive pricing discrepancy between paper and physical is flowing to close that gap. The only way to stop that flow is to close the gap. And closing the gap means COMEX prices have to rise to 127. That's why I'm not worried about rule changes. I'm watching for them. I'm prepared for them, but I'm not worried. Because you can't manipulate physics. Metal is heavy. Shipping takes time. Vaults have finite capacity. The physical world doesn't care about regulatory announcements. It moves based on incentives. And right now, the incentive is clear. Drain COMEX, ship to Perth. Let me bring this home. What happens if I'm right? If Perth premium persists, if COMEX catches up, if we hit $140, what does that world look like? First, mainstream adoption. When silver crosses $120 and stays there, it breaks into mainstream consciousness. Right now, precious metals are niche, but once silver holds triple digits above $100, headlines appear. CNBC covers it, Bloomberg covers it, Wall Street Journal covers it. Retail investors who never touched commodities start asking questions. That's when real FOMO kicks in. Your dentist, your accountant, your neighbor start asking about silver. That's usually a sign we're near a top. Second, industrial panic. If silver stays above $120 for weeks, industrial users freak out. Solar manufacturers, electronics companies, everyone using silver in production scrambles to lock in supply. They hoard. They try to substitute. But substitution takes time. In the short term, high prices don't destroy demand. They create panic buying. And panic buying pushes prices higher. Third, sovereign accumulation. Central banks buying gold at record levels for 2 years. If silver enters a reset scenario, some central banks diversify into silver. Not a lot, maybe 5 to 10% of precious metals allocation. But when sovereign wealth funds put billions into a small market like silver, prices explode. So if I'm right, $140 isn't the end. It's the middle. After $140, we could see $160, $180, maybe $220 if things get out of hand. But here's what you need to understand. Parabolic moves end. They always end. And when they end badly. 1980, 90% crash. 2011, 70% crash. This one will end too. Fast, brutal, unforgiving. So if you're holding silver through a run to $140 or $160, you need an exit plan. Know your price. Know what percentage you're willing to ride back down. Because without a plan, you'll freeze. You'll watch it run to 175. You'll convince yourself it's going to 300. Then you'll watch it crash to 95 in 3 weeks. You'll end up where you started, traumatized, never touching silver again. Don't let that be you. Have a plan. Know your exit. Take profits on the way up. Don't try to time the top. Sell a third at $115. Sell another third at $135. Ride the last third. Or whatever works for you. Just have a plan. Here's my final word. The data is the data. Perth quote of $127 is real. The $36 arbitrage gap is real. The physical drain is real. The gold-silver ratio is collapsing. All factual. What's not factual is where this goes next. I can show you the math. I can show you historical patterns. I can tell you what I think is likely, but I can't tell you what will happen. Nobody can. Markets are chaotic. Anything can happen. So take the information. Do your research. Make your decisions. And whatever you decide, do it with conviction. Either you believe the thesis and position for it, or you don't and stay on the sidelines. There's no middle ground when markets move this fast.